And joining me for a closer look at the day's markets action is Chantal Marx from FNB Wealth and Investments. Chantal, thanks so much for your time this afternoon. So US President Donald Trump marking 100 days in office, that coming with some relief, of course, as he signed an executive order to soften some of those auto tariffs, particularly on the components side. And this, of course, benefiting the car companies that are manufacturing their cars in the US. We've also had some progress when it comes to the trade talk side, with a report saying that Trump is close to reaching a deal with India. Talk to me about what you've made of, Trump's approach in the last few weeks. We've seen him also talk to a number of big companies. The retailers come to mind as well.
So it's been nothing less than chaotic, right? So even though we have seen a reprieve in the last week or so and markets have reacted accordingly, the reality is that it's created so much uncertainty because you've got these big sweeping changes that are implemented and then kind of pulled back slowly. And remember that with the 90-day reprieve, we're not at 90 days anymore. It's creeping ever so closely to perhaps further tariffs or those older tariffs being reinstated if deals aren't reached soon. So while it's good that there's go forward momentum, it seems as if there's a willingness to negotiate with China. Some trade deals are being put in place with some of the larger economies in the world. It will still have knock-on impacts if those tariffs go ahead. And this is just one policy area. This is the first of some of the many promises that was made by the Trump campaign previously. And if this is the approach, I'm a little bit nervous.
And sticking with the auto sector for a bit, German automaker VW reporting downbeat numbers. I think profits were down 37%. They've also noted, the impact of those tariffs and the impact it would have on its outlook. But to be honest, that company has been facing difficulties for quite some time. You think of, tough competition. Last year, they even announced that, or rather were considering closing down 3 factories in Germany. So I guess these numbers not coming as a surprise, and that, that tariff picture just adding further pressure on the counter.
Yes, that's exactly that. I think that the company's been under pressure for quite some time. And you have seen similar trends coming through from other German automakers. I know Mercedes-Benz also reported results this morning, also doesn't look great. Porsche a few days ago also didn't look great. And it's that competitive pressure coming through from these cheaper Chinese brands, particularly in some of their markets where they've been very strong historically. I mean, we can see on South African roads what the new cars are that are driving around. It's not the new Tiguan, it's a Haval. So you need to take that into consideration. And then in the electric vehicle race as well, BYD really stepping up, pushing volumes into the European market. All of this has had a negative impact. And then coupled with the uncertainty related to tariffs and a few other things that have happened to some of these companies over the last few years, I'm thinking particularly about the emission scandals that they've faced. It's just been really tough going for them.
And you mentioned the likes of Porsche also pulling back on their forecast. Do you think, the counters like Porsche, Ferrari have, I guess, more room to pass on those price increases, considering that, the consumer that's buying Porsche and Ferrari vehicles?
So I think Ferrari is relatively more shielded. They only produce about 13,000 to 14,000 cars a year, and their clientele is at the extreme high end in terms of income groups. Porsche, even though they are catered towards a high-income individual, they do also have mass market appeal, particularly in the SUV space, where most of their volumes are being pushed into. And they're also very exposed to the United States. And I think that the tariff impact there could be so much greater.
All right, let's move over to Asia. We had some factory activity numbers out of China. PMI slipping to a near 2-year low in April and falling into contractionary territory, with many pointing to, trade war factors weighing on productivity on that front. Not good news for the sector, not good news for the economy at large. And I guess also just fueling those calls for further stimulus for that economy to be boosted.
Yes, so I think the PMI numbers would also indicate quite downbeat sentiment. And I think that that's, again, a function of the uncertainty that we spoke about earlier, although we spoke about it in the context of investment from a market's perspective. But for a business owner and for a manufacturer, these factors are extremely important in terms of generating further activity, increasing capacity, and the like. And it does seem as if there's been an initial hit. It has not that massive. It's a small contraction in activity indicated by the manufacturing PMI, but still it's had knock-on impacts. It's even impacting our bourse today because we have any company with Chinese exposure under pressure today, and all of the diversified miners also coming under pressure today because commodity prices have fallen.
Yes. And talking about diversified miners, Glencore out with a production report for the first quarter. Guidance for most of its commodities has been maintained. What I found interesting, though, was, the decline in copper production and the difficulties they're also facing in the coal market. What caught your eye in that report, Chantal?
Yeah, I mean, so when you're looking at these production reports, they're released on a quarterly basis. And sometimes there are things that happen at some of the operations that are largely outside of management's control, or they are specifically planned. So from Glencore's perspective, the thing that I would focus on is whether or not they maintained full year guidance. And they did maintain full year guidance for across their commodity basket. So I'd take comfort in that in terms of anything that went wrong this quarter or anything that wasn't, that may have looked a little bit weaker than expected this quarter will probably be made up as the year progresses.
So that report, not too bad, but we are seeing that share price under pressure, losing 6.4%. But you did mention commodity prices under pressure following downbeat sentiment in China. Before we get into our stock picks, Chantal, I just want us to look at MTN Nigeria. Currency devaluation problems seem to be subsiding, and we are seeing, a return to profit in that business. Just your analysis on those Q1 numbers.
Yes, so there does seem to be some really good go-forward momentum in MTN Nigeria. Probably the last few quarters have been quite decent, and this is just a continuation of that. Underlying growth is there. The move towards value-added services and data is still there. I think what's really helped MTN over the last quarter, particularly and probably the quarter before that, is the fact that they've actually rebased their cost base. So their cost base isn't as dependent on Naira devaluation anymore, and I think that that's already starting to show.
All right, let's hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
I stay in cash.
Yeah.
I'm ready to pounce, but not quite yet. We need, as we spoke about when we started the show, we need certainty. You need certainty in this market, and until such time, all markets are going to be all over the place. So you're really playing kind of Russian roulette.
My stock is MCO. They are in the construction sector, but more mechanical and electrification kind of construction in the US. They certainly look like a business that has been able to consolidate the market in the US and has shown decent growth. It's expanding into the UK. I think with the data centers, they play in the space, in the data center space as their growth and building is developing there. So I'd like to think that it would probably longer term, it would deliver good returns for investors.
So Zwelakhe going with MCOR, and David surprisingly playing it safe with cash. Your analysis on that counter and whether, you'd prefer to play it safe in this kind of environment.
Yeah, I mean, so MCOR is quite an interesting one. I actually had to go and do a little bit of digging on the company, but very much exposed to the US economy, kind of a harder industrials type play in the US. The valuation doesn't look nearly as demanding as for the US tech space, for example, some of the other companies that we know quite well there. I think in an environment where the US becomes more US-centric, a company like that could do well. Of course, it does have expansion plans in place, so there's always that lever to pull, and then exposure to the data center thematic as well. So yeah, I mean, a really interesting one. Growth doesn't look that exciting, but I think it's a pretty decent place to hide. And then cash, what a great place to hide. But yeah, I mean, the reality is, where do you get the cash from? So I was thinking about where would I get cash from currently, and I think it's probably a good time to start reevaluating that gold exposure, perhaps the gold mining exposure, and sell into strength to build up your coffers to take advantage of opportunities when they arrive within this volatility that we're seeing.
So where are you, seeing opportunity at this point in time? Are you picking a stock, or are you playing it safe?
No, I'm picking a stock. So We Buy Cars released a really solid trading statement yesterday, and they were actually down by over 3% on the day. I think that there may have been some profit taking place, but if you look at the valuation of We Buy Cars, it's trading on a forward P of 40 times, but with growth expected of about 20% each for the next 3 years. So I think the stock is still cheap relative to its growth prospects. I think the industry it plays in is really interesting in the South African context, used vehicles as opposed to new vehicles, given affordability constraints locally, and in a very fragmented market where there's still lots of mom and pop shops to gain market share from, unfortunately. But it will be to We Buy Cars' benefit. I think they'll meet their growth targets and probably exceed their growth targets that they put to the market when they listed. And so far, so good. 24 to 28% increase in underlying earnings per share is really remarkable in this environment.
Chantal, thanks so much for joining us this afternoon. That was Chantal Marx from FNB Wealth and Investments.